Mark your calendars, guys. December 14th is the next Fed rate hike meeting, and some experts are calling it a turning point for the next phase in the Fed pivot. Why should we care? Well, they are predicting that smaller rate hikes are coming soon, and they're even leaving more clues about it in their notes for the markets and for investors. Really, this could be make it or break it news for stocks and other assets like real estate and crypto. And when I say real estate, we're talking about the very same real estate assets that are impacting renters, home buyers. I don't care if you're on Section 8, EBT, SNAP benefits, everyone will be affected by the Fed's next rate hike decision. Are you on fixed income, Social Security, SSI, SSDI, railroad retirement benefits? Oh yeah. And the price of goods that we're seeing in the stores? Yeah. You see, the stock market won't see a sustained rally until the Fed starts cutting interest rates, and this will not occur until at least these three things happen. At least this is how big investment bank JP Morgan sees it. But Mr. Powell, you can't raise rates on Christmas, right? You know what Jay Powell says to that? Bah humbug. Nah, seriously though, what do you guys think about Jerome Powell and the Federal Reserve's rate hikes? Are you feeling the pinch in your credit cards? What about your mortgage payment, your rent payment? Drop me a quick comment down below. Let me know what your situation's like. All right, so here's the Jerome Powell promise. Those Fed rate hikes are going to ease soon, and you'll hopefully start to see it and feel it in your wallets and your cash flow. Here, check this out.
Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
All right, so let me set the stage for you guys real quick. See, inflation peaked back in June, but wait a second, prices are still going up, right? Yes, that would be correct as well, but we're still feeling the pinch, Ron. Have you seen holiday prices lately? Yes, I have. But what I'm talking about here is the rate that these prices are going up. Basically, prices, they're still going up, yes, but the rate that they're going up is slowing down, at least compared to how fast that prices were going up back at the June peak. We reached 9% inflation back then, and the last we saw was for October at 7.7%. Now, putting aside the fact that these are probably understated government figures, we're still crossing our fingers that those price increases are decelerating at least. Now, looking at the Fed, they may be feeling pretty good about themselves and probably even congratulating each other for a job well done. Now, whether they deserve congratulations or not, that remains to be seen. The way that the Fed tames inflation is basically by destroying the economy, nearly collapsing the economy with interest rate hikes. Now, housing markets, they're in the dumps. Business capital investments down, venture capitalism, and the stock market is in the bear territory. More on that later. Crypto like Bitcoin and Ethereum, Dogecoin, it's all down as well. Now, I don't have to tell you guys, it's been one heck of a year for the US economy, most of all for low-income Americans as well as middle-class Americans like me and you. Now, with all this being said, all the financial education and money-making experts, they have their eyes set on December 14th. This is when the Fed will more than likely initiate phase 1 of the Fed pivot. And by phase 1, I mean that they're probably going to be raising interest rates by 0.5% instead of the 0.75% that they've done in each of the last 4 meetings. Experts predict that there's an 80% chance that the Federal Reserve raises interest rates by only 0.5% on December 14th. Yeah, I know what you're thinking. Raising the interest rate 0.5% instead of 0.75% is kind of like getting hit by a car instead of getting hit by a truck, right? Either way, it hurts. Most Federal Reserve officials at their last meeting favored reducing the size of their interest rate hikes soon. Now, according to the minutes from the last Fed meeting, the central bank's policy makers, they saw very few signs that inflation pressures were abating. Still, a substantial majority of the officials felt that smaller rate hikes would likely soon be appropriate. And as the economists broke it down here, slowing the pace will give the Fed the ability to assess the economic landscape and see where we're at. Short of some wild inflation report before the next meeting, a 0.5 percentage point hike sounds very reasonable in December, but the Fed is clearly not finished yet, end quote. Of course, nothing's for sure until we hear from them. Even Fed Chair Jerome Powell stressed at a news conference after the meeting that the Fed wasn't even close to declaring victory in its fight to curb high inflation. Still, some of the policymakers expressed their hope that falling commodity prices and the fixing of the supply chain bottlenecks should contribute to lower inflation in the medium term. Now, at the same time, if the Fed officials start slowing down their rate hike increases, Americans will finally feel that there's an end to all this high inflation. Maybe they'll also start reducing how many layoffs there are. See, if people expect high inflation to go on forever, they act in ways that can make those expectations basically self-fulfilling prophecies. So, for example, like demanding higher wages and spending too much before prices can further accelerate. Now, over the past few weeks, we've heard officials pretty much say the exact same thing. The inflation fight is still going on, but they could see a pullback on the level of rate hikes. Translation? There's a strong likelihood of 0.5 percentage points increase in December, but this is still an uncertain course after that. Markets expect a few more rate hikes in 2023, taking the Fed funds rate to around 5% and then possibly some reductions before the next year end. So when will the rate hikes end? Well, according to an expert from Yale, they're getting to a point where they don't have to move so quickly. This is helpful since they don't know exactly how much tightening that they're going to have to do. They emphasize that the policy works with lags, so it's helpful to be able to go a little bit more slowly, end quote. Plus, it would also be nice to hear some good news during the holidays for a change, right? Investors and entrepreneurs are hoping for smaller rate hikes. Traders are now pricing in a more than 75% chance that the Fed will raise rates by only a 0.5 percentage point at its December 14th meeting. And so this is up from the odds of 52% for a 0.5 point hike a month ago, but it's lower than an 85% likelihood of a 0.5 point increase that was priced in just last week. They're taking things positively with the recent batch of inflation reports that seem to suggest that the pace of a runaway price increase is finally starting to slow to a little bit more of a manageable level. The job market remains relatively healthy as well, although the most recent jobless claims figures ticked up just a little bit from a week ago. But as long as the labor market remains relatively firm and inflation pressures continue to ebb, the Fed will likely pull back on the multitude of its rate hikes. The last thing we want to see at this point is higher interest rates for mortgages, driving up the cost for rents, making renters have to pay more money, and even drying up the supply of available landlords willing to rent their properties out to Section 8 tenants. Now, some experts are getting concerned that if the Fed goes a little bit too far with their rate hikes, the increase could eventually slow the economy too much and potentially lead to much higher unemployment, job losses, even a recession, maybe like what we saw back in 2008, and certainly we hope that we'll never see another depression again. I mean, we've already seen a very clear impact on the housing market, nearly immediately, with the surging mortgage rates making a very serious dent on the demand for home sales. This is probably going to be a big one that could determine a serious crash or a rally in the stock market and other asset classes before the end of the year. So when the Fed minutes come up, the stock market responded with a higher close. Dow Jones went up 95 points. to 34,194. The S&P 500 was also up and it closed at 4,027 points. The NASDAQ increased to 11,285. So what it really shows is that if you've got a market that's jittery about one thing and one thing only, and that's the Federal Reserve and what their thoughts are on monetary policy. So yeah, investors, renters, entrepreneurs, real estate business people, they're all looking at December 14th's meeting for what they should do next. Or at least the smart renters are. Some people have just lost hope altogether. I know people who have said that they've already experienced the peak of our era, that this nation is probably going to fall to corrupt rulers like Rome did. Sad to think of what this would mean for people's pensions and the rising cost of living. We sure know that Social Security, SSI, SSDI, and the Social Security increase for 2023 sure isn't keeping up at the rate that many people living off of fixed income would prefer. Let's seriously hope not, but I do have to admit I am seeing some horrible foreign policy, bad regulatory policy, bad fiscal policy, and bad energy policy. What do you guys think? Hit the like button if you guys agree. Big investment bank JP Morgan says the stock market won't see a sustained rally until the Fed starts cutting interest rates. And this won't occur until these three things happen. The S&P 500 surged 14% from its mid-October low, but more and more investors are worried that it's just going to be nothing more than a bear market rally that will ultimately give way to more downside as the Federal Reserve gears up for another interest rate hike next month. Now, according to the expert JP Morgan, as long as central banks raise rates or keep them at current levels, we believe assets will be range bound with a more pronounced downside risk, end quote. So what needs to happen before we see a serious stock market rally? Well, the Fed needs to cut interest rates and not just slow down rate hikes. And that can only happen if we see these three factors in the economy. Number one, increased unemployment. Two, declining inflation. And three, something breaking in financial markets. Now, the likelihood of all that happening soon is probably not very high. And like they said here, as an increase in unemployment is not likely to happen very soon, markets will be on edge between waiting for better inflation data, slowing economy and earnings, and rising risks of financial accident, end quote. There is one way that we could see this happen. That is if an economic recession materialized in 2023. You see, that could actually be the final straw that causes the Fed to get scared to ease financial conditions via interest rate cuts for your credit cards, mortgage payments, and even pause reversal in its balance sheet reduction program. Now, until then, investors, they shouldn't put too much stock in a stock market rally unless the Federal Reserve gives signs that it's going to pivot away from tightening and towards easing financial conditions. But still, there is a lot to look forward to in the next meeting. I mean, you saw how markets reacted to just the possibility of a Fed rate hike slowdown, right? I mean, just imagine how much more money you could make if you get in at the right time before stocks really take off. Always stay subscribed to the channel and keep the notification bell turned on, you guys. You do not want to miss it when we finally make that announcement. I promise you guys, we will be the first to know right here on the channel. Always stay tuned in. So, did you guys catch all the information in today's update and daily news report? The Fed rate hike meeting happened on December 14th. The stock market crash or rally that could happen right after it. And after all the money opportunities that go along with the news, if you guys did not catch all of that, you can always rewatch this video. Lots of good information here and lots of good money making opportunities if you know what to do next. Now, of course, you can always check out the channel playlist section for all your favorites like Social Security, SNAP, and EBT benefits, and all of the side hustles and money making ideas that you want and need going into 2023. They're all waiting for you guys right there, so definitely check those out after this one. And while you guys are doing that, I will be busy working on the next important update for you guys. As always, thank you so much for watching. Thanks for dropping a like for the video. Make sure to get your free home warranty quote. The link is in the description down below. And I'll see you guys on the next one. Be safe.